Well, hello. We're going to be talking to you today about title loans. A lot of you are unaware of what title loans really are, and so let me just drop back just a little bit. When we go to a bank and we want to invest our money with that bank, or in other words, they're going to borrow money from us, they may give us 1 or 2% currently, like in a CD, or maybe even less than a half a percent in a money market account. We might put in 100, 200, or even $300,000, but when we leave that bank, we have no collateral. We don't own the vice president's car. We don't own the building. You see, all we get is that little interest rate and a little piece of paper, and it may say FDIC insured. And you want to know a little bit more about FDIC? Go look it up. Anyway, what you have there is a situation where the bank uses our money, pays us a very low rate of return, and the only thing we have protecting our money is the bank's word, basically, that they're going to be able to pay us back. But what about the bank? What do they do differently? You see, when you go into a bank and you borrow money from a bank, it's a little bit different, isn't it? Let's say that you borrow 100, 200, or even $300,000. Well, what happens here is your bank's going to own your firstborn child, your house, maybe even your car, or some other things. You see, your good credit would allow the bank to have confidence that you're going to pay them back, of course. But in the event that something else goes wrong, guess what? They want collateral. They want to know that they have something to fall back on for themselves and or for other investors that have put their money with them to be able to go back and try to get the money that they've lent out, right? But see, they do things a lot differently. Not only do they require collateral, but they're also going to charge more interest. You see, how many of us would like to be the bank? You know what, to be able to protect our money in such a way, and that we know that no matter what happens, we have the best of opportunities of getting our money back. And not only that, by lending our money out, we're going to get a much higher rate of return. And so let's talk a little bit about that. There are people today, for whatever reason, may need untraditional financing. And so they may approach companies that do title loans. In fact, I've seen a lot of commercials lately in different states that advertise title loans. Well, one such company, I mean, they even claim to do a title loan within about 10 minutes. Wouldn't that be remarkable? Now, they do make incredibly good returns on that, sometimes as much as 80, 90, or even 100%, for what they do. But the loans are always fully collateralized. And with that, you might ask yourself, why participate? Well, one of the main companies that we use, first of all, has a lot of experience. They're exceptional when it comes to being able to determine the right type of loans to lend out on cars. The one fellow that we deal with has over 13 years of experience in this area. Collateralizing is also another very important feature. You see, a majority of loans offered through the banks require collateral, like we mentioned, whether it's buying a car, a house, or any number of other things, right? But they're always going to require some collateral. This creates additional safety for the banks and the investors, as we spoke about. All the loans offered by these companies that do title loans, you see, usually will end up to no more than 50% loan to value. And so with that, it adds additional safety there. Tracking the vehicles also have become no problem because a lot of these companies install a GPS system in the event that there may be a default. Monthly income is one of the primary purposes of people becoming the bank and loaning money to these companies to be able to lend out for these untraditional financing. You see, because the exciting feature on this is that it usually will give you anywhere from 10, 11, 12, and even 13% return. See, where can you go today, have a very good return, and have your investment collateralized as well? Well, typically, you have a situation like this. It talks about having higher, risk with higher returns, but not in this particular case. The terms on this are usually very short, around 18 months, and they offer quicker access to the principal if you need it for other purposes. Now, this also happens to be a fantastic growth industry. Some of the sources report as much as a 30% annual increase. Very few industries this time of year or any other time of year experience this. This is such a great thing that we have repeat customers. On the average, well, let's talk about the title financing potential growth or income that's available to you. I'm going to show you a hypothetical growth and income options here. Let's just assume that an individual may put away about $300,000 into title loans. earning as much as maybe 13% in this particular case. Now, if you're going to compare that to other things, you're going to see a dramatic difference. But here you have your loan fully collateralized and you have an exceptional interest rate. So let's just take a peek at this right now. If you invested $300,000 and allowed it to accumulate over a period of years, in about year 5, you'll find that your $300,000 has almost doubled. In fact, it's worth about $552,000. You say, how amazing is that? If you let it go all the way out to year 10, it's almost tripled at over $1 million. And going down to year 20, oh my gosh, you're looking at $3,456,000. Well, for some of us, maybe what we're more interested in is getting a monthly income. When we look at $300,000 currently invested, maybe even in a money market account at less than 0.5%, or some of the CDs, or even some other investment vehicles out there, you'll find that the rates of return on a monthly basis are not that substantial. But take a look at this. $300,000, never touching principal, earning on the average of about 13%, will generate $3,250 a month every single month, year after year after year, without ever touching principal. How powerful is this? So when you look at the growth potential, you're looking in 5 years at $552,000, 10 years at $1,018,000, 15 years at $1,876,000, 20 years $3,456,000. Well, one of the great features here is that it helps us meet the short, medium, well, let's talk about title financing again, maybe versus an annuity. Now, annuities are also considered very safe. There's basically 3 different types of annuities: from a fixed income and an indexed annuity, and also a variable annuity. There are advantages to each one of those that we may speak about today, but if you did have an annuity that, let's say, it averaged 4% return, you understand that would still be a fairly high return in today's economic environment. So let's just take a peek at and compare the two here. Here we're going to have a $300,000 investment compared to an annuity. That annuity at 4% will grow every single year. Year 1, that $300,000 is now worth $312,000, and so on. Year 5, that annuity has grown to $364,996. Year 10, $444,000. Year 15, $540,000, and out at 20 years from now, you're looking at $657,000. Now let's peek over here for a moment, invested at a much higher interest rate, because we are allowed now to utilize the title financing side of it. Again, having our investment completely collateralized. Now, what's going to happen here? That $300,000 at the end of year 1 is $339,000, and remember, comparing it to that annuity at $312,000. Let's go out here to year 5. The annuity was $364,000 approximately. The title financing, allowing the money to accumulate year after year, is $552,000. That means the difference after 5 years is $187,000. That's a substantial difference, and for a lot of us, you see,